And I think you have to kind of take a step back and see what the biggest players in the world are doing. And the biggest players are the central banks who are massively de-dollarizing and buying commodities. And I think that's kind of the thrust that fits hand in glove with Zoltan Pozsar said. We are heading into a new era based on commodities and transparency, not opaque debt instruments and promises that seem to fall short. And I just think that this is something that will be a very, very.
You're watching Silver News Daily. Like this video and subscribe to the channel for the best news that you don't want to miss. Now let's get straight to it. Today, I'll be breaking down exactly how gold will reach $5,420 based on my own in-depth research. I will include valuable insights from the likes of Andy Schectman, Miguel Oliver, Rip Rule, and many more, so stay tuned. Now, imagine stepping into a world where the US dollar, a cornerstone of global finance for over a century, is no longer the anchor it once was. Picture a reality where nations, leading investors, and central banking institutions are not just diversifying, but aggressively pivoting towards gold, propelling its value to an unprecedented $5,420 per ounce. This isn't a speculative bubble or a fleeting trend. It's a paradigm shift that's quietly unfolding right under our noses. World leaders, economic strategists, and central banks aren't just observing from the sidelines. They're actively leading this charge, recognizing the winds of change and positioning themselves at the forefront of what could be the most significant financial transformation of our time. This shift isn't born out of a mere whim or unfounded speculation. It's the result of a series of calculated moves, a response to the evolving global economic landscape marked by volatility, shifting power dynamics, and a reevaluation of what constitutes true value and stability in our modern world. The once unshakable confidence in the US dollar is being eroded, not rapidly, but steadily and surely, like a glacier reshaping the landscape, not through abrupt action, but through persistent, unstoppable force. The implications of the shift are profound and far-reaching. It's not just about the increase in gold's price or the depreciation of the dollar. It's about a fundamental change in how wealth is perceived, stored, and secured. In this emerging reality, gold isn't just a commodity or an investment. It's a beacon of stability, a sanctuary in a world brimming with financial uncertainties. It's a statement, a strategy, and for many, a lifeline. As we embark on this journey through the intricate web of economic trends, market analysis, and strategic foresight, remember this: knowledge isn't just power, it's your armor and your compass in this new era of gold. Stick with us as we unravel the why, the how, and most importantly, how you can not only safeguard your wealth, but also thrive and potentially retire with riches in this golden era. The path ahead is laden with insights, revelations, and opportunities. Welcome to the Golden Shift, a saga of transformation, resilience, and unprecedented wealth creation. Stay tuned because this isn't just a story, it's your future unfolding.
I don't know that it happens in 2024, but I would say it's damn near close to 100% that it does happen. That is what they are intending to do, barring any unforeseen events. It is how you gain legitimacy. When people say, who's going to trust Russia or China, they'll say, look at the European Union. It didn't work. Well, they didn't have the glue that holds it all together, and that glue would be a backing of something that is legitimate. And if you back just enough to inspire confidence, you still have the ability to expand the money supply, to do monetary things that, a 1-to-1 ratio wouldn't do. And I just think there is no way that these countries, because of all of the points that are fair and valid about China, about Russia, about all these countries, that I think it's important to look at the way the rest of the world looks at the United States when we make that comment. How do you think Iraq feels about the United States? Now, again, I'm a patriot. I love this country. I am not rooting for this to happen, but I'm saying when you look, if you are in an argument or you are in a debate class or you're an attorney, if you only focus on your argument and don't look at their argument, you're going to lose. And I think their argument is one that is compelling. And I think the only way to make it work, to take all of that out of the equation, the lack of trust in a new system based on who's backing it, well, fine, I agree with that. But what if you have a way to sidestep that? And that is to pledge what is now, according to the BIS, the only other tier 1 asset to something like that is immutable, like a blockchain, and show the veracity of it so you can't screw with it.
As we delve deeper into this transformative saga, let's turn our gaze to the recent ripples in the gold market, stirred by the influential remarks of Federal Reserve Chair Jerome Powell. Picture the scene: the gold market, a colossal giant of the financial world, swaying within the $2,030. $2,040 range, its pulse quickening with every word uttered by Powell post-rate decision. His comments, subtle yet seismic, hinted at potential rate cuts contingent on economic progress, yet with a tone of caution, stressing no rush in altering the current monetary stance. It's a high-stakes game of patience and prediction, where every nuance can tilt the scales of market sentiment. Powell's artful dance around the prospect of a March rate cut, combined with his steadfast approach to managing inflation, sent waves through the gold market. The price of gold, which had been basking in the glow of earlier gains, found itself retreating, reacting almost viscerally to the Federal Reserve's decision to maintain the status quo on rates, while pushing back against the whispers of rate reductions. The yellow metal, a beacon of stability in turbulent times, seemed to momentarily lose its luster, hinting at the intricate and delicate balance that governs its valuation. Yet, beneath this ebb and flow lies a deeper narrative. Powell's commentary is but a single thread in a complex tapestry of economic indicators, policies, and forecasts. The Federal Reserve's stance, while cautious, opens doors to possibilities, hinting at a future where the dance between interest rates, inflation, and gold prices becomes even more intricate and consequential. As the 10-year Treasury note yield spiked and the US dollar index aimed for new heights before recoiling slightly, market participants found themselves deciphering signals, reading between the lines of Powell's remarks and the Fed's monetary policy statement. The volatility in the XAU/USD trading arena, the sharp reactions to Powell's dismissal of a near-term rate cut, and the market's hypersensitivity to these high-level economic signals underscore a pivotal truth. The bull market is not just a reflection of current economic conditions. It's a seismograph for future expectations, global sentiment, and the collective pulse of financial stability. As we navigate through this intricate landscape where every policy statement and economic indicator can sway the fortunes of markets and investors, remember this: the dance of gold prices in the light or shadow of monetary policy is a tale as old as time, yet it's being choreographed anew in our era, against a backdrop of shifting economic paradigms and a world reevaluating the true anchors of its wealth. Stay with us as we unravel the strands of this story, revealing not just the movements of today, but the emerging trends that will define our tomorrow.
Yes, so again, as I mentioned, if we go to US oil, which is WTI typically, I do feel this is what happened March 2020. Now, there was very specifically an end to movement, but I do feel that you can't rule out such a thing happening again. And this chart is not looking nearly as good as the uranium chart. On the uranium chart you had two highs, and the second high was almost as high, and you're holding a blue line at 28.50. If you look here in the oil chart, you can see exactly what this is telling you. This pulled all the way back. We called this top on a bit of technical analysis here, and it's come right the way down. And this rally is not nearly as strong, and this is pretty flat. And can I also point out, OPEC Plus, which includes Russia, has twice done production cuts. So the notion that this economy is everything is awesome. I prefer the image of the dog drinking his coffee and everything's burning on fire, if you know the difference. And he's saying everything is awesome. This is not, on two production cuts, a good, and that's again, statist involvement. They're matching the amount of production and they are cooperating so that they don't both force a glut as we had over here when they weren't cooperating and everybody wanted a minimum amount of revenue, and as the oil price dropped, pumped more oil to make their number, and you got an absolute glut at a time where everybody stopped driving, stopped flying, and stopped doing everything. Well, that's a great way to screw your market up, as you then saw, and I think we went from a few hundred offshore drills to about 3 or 4, and most of them hit the wall. So this is not technically strong compared to the uranium, and I'm hoping guys will appreciate that. And I could see on a further weakness in the economy us trading below that level. So what is that level that you kind of a floor on at the moment? Let me just grab the price chart. Roughly around the 70s level. I could see us slipping through the 70s into the low 60s and possibly the 50s. So I'm not short or even medium term on account of the consumer and demand destructive events, which we are already in with the super high inflation, which is higher than the BLS numbers are telling you, the state of the debt collapse, and the potential for more downside event risk. Let's just leave it there. So that is not a good setup for oil. as not a good setup for oil. We already have all the wars. We've got an Israel war that's likely to expand into Lebanon chasing Hezbollah. We have Ukraine, Russia that can always escalate. None of that's done anything for the oil price. We've had 2 production cuts. That tells you consumer wrecked, not flying, not driving, and it's also in packaging, it's in deliveries, it's in everything. So oil is much less interesting. Longer term, if you talk in 10 years, if the system is, and we could still price it in current dollars, assuming that currency still exists, I would expect it to be higher, but not the...
In this unfolding narrative, we find ourselves at a crossroads of global economics, where the once unchallenged dominion of the US dollar is being subtly, yet unmistakably questioned. The whispers of de-dollarization are growing louder, echoing from the bustling markets of Brazil to the vibrant trade hubs of Southeast Asia. This isn't just a regional trend, it's a global chorus calling for a shift in the very foundations of international trade and finance. The greenback, revered for its stability and ubiquity, is witnessing a slow but steady erosion of its hegemony. Countries, driven by a blend of geopolitical shifts and economic pragmatism, are increasingly advocating for trade in a kaleidoscope of currencies, challenging the dollar's reign. This is not an overnight revolution, but a strategic evolution, reflecting a world that's growing more multipolar in its economic orientation. Despite this undercurrent of change, the US dollar, it must be acknowledged, continues to hold the throne in global forex reserves, a testament to its enduring strength and legacy. However, the landscape is shifting, the tectonic plates of global finance are moving, and the dollar's share in central banks' foreign exchange reserves is not what it once was. From the commanding heights of over 70% in 1999, it has descended to newer realms, painting a picture of diversification and perhaps a hint of vulnerability. The forces propelling the shift are as diverse as they are dynamic. Geopolitical risks, economic strategies, and the relentless march of innovation are reshaping the contours of global finance. Central banks, the sentinels of economic stability, are recalibrating their reserves, diversifying into a more multi-currency mosaic, not just as a hedge against volatility, but as a statement of economic sovereignty and foresight. In this grand chess game of currencies, the US dollar finds itself at a pivotal juncture. Its dominance, while still undisputed, is being recalibrated in a world that's increasingly seeking balance, resilience, and multiplicity in its economic underpinnings. This isn't just about the economics of trade or the mechanics of forex reserves. It's about the very narrative of global finance, where diversity, stability, and innovation are becoming the new cornerstones of strength. As we peel back the layers of this complex, evolving story, one thing becomes clear. The future of global finance is not written in the stars, but in the decisions, strategies, and visions of nations and institutions navigating through these transformative times. The US dollar, with its storied past and formidable presence, is facing a new chapter, one where its role, while central, is part of a larger, more diverse mosaic of global economic cooperation and innovation. Stay with us as we continue to explore the depths of this narrative, uncovering not just the trends and numbers, but the stories and strategies that will shape the future of our global economic landscape.
Realized losses, the key word, of course, is unrealized. So that means that if these banks had to cash out their long-dated securities, you see that's in the dark blue or black, depending on your screen. And in some cases, it looks like it's almost 50% or close to it of the bank's total holdings. So that's very, very concerning for the whole banking system, because they're all interconnected. And yet the other chart shows that their net income is actually pretty stable, and it doesn't show much real loss. So the way you reconcile it is this. The reason there's the unrealized losses, we'll just go over the basics here, is because interest rates have been increased. So those 30-year treasuries, those long-dated bonds, even the 10-year note, have decreased in value. So if you had to sell them now, you'd be selling them at a loss, and you can see the losses are substantial. And that has been done. And yet you get a net income, which is like a real head scratcher. The reason it is the way it is that the Federal Reserve said, okay, here's what we'll do. We will let you put up your securities, whatever they are, whatever the maturity is, and we'll loan you the face value. So you don't have to take a loss immediately. You're getting a loan. So if you had a house that was worth $100,000 and had a big market crash, and the house is now worth $70,000, and your banker was really, helpful to you And he said, you know what I'll do, Elijah, is I'm going to give you the old value of 2 years ago. I'll give you the 100,000, but it's only for 1 year. And 1 year from now, you've got to pay me back. So that's how you can have all this net income, is that because the banking system has been drained of liquidity as far as ready cash. Cash deposits have all moved into money market funds, which means the banks are even more insolvent, yet their net income looks good. Well, why is that? Because they get to play the spread. So you get to get all this, I'll call it free funny money, and you borrow it at X and you loan it at a point higher, and you're making that spread in your direction. So of course your income looks good temporarily. Now, when the call comes, literally it's called a call loan, and they call and say, Elijah, the year's up, worth 100 grand. These banks, will they pay it? Can they pay it? Or whatever. The other thing that most people don't ever talk about in a fractional reserve system is how really convoluted it is on interest rates. You don't really ever delve into this part of the equation very often, or at least I haven't heard it very often. So if I only have to have a 1 to 10 ratio, so if you deposit $100, all I have to put on the account is 10 ready cash, and I get the other 90% to loan. Instead of, getting 1% on the $100, I've got 1% on the 9, but it's loaned out again and again and again. So that 1% goes to my bank, and then I send it to another bank, and they get 1% on the $80, and then the next bank gets it on. So you're really getting like a 10% yield on a 1%, if that's the going rate, let's say, loan, because you've spread that money out 10 times. Of course, it's decreased slightly all the way down from, you have to hold $10, so you loan 90, so 90, you have to keep 90, you have 81, and on and on. You do the arithmetic. But I don't think people think about those multiples, because the system is so leveraged or geared, as the Brits say, that it goes both directions. And that's why those bond unrealized losses are so huge. So did I explain it where you understand it? Because
as the narrative of global economic realignment unfolds, we turn our focus to the geopolitical chessboard, where the strategic maneuvers of nations are reshaping the dynamics of power and wealth. The BRICS nations, a coalition of emerging economic powerhouses, are at the forefront of this transformative tide, steering the conversation towards a future less tethered to traditional financial paradigms. This is a story not just of economic recalibration, but of strategic foresight and bold initiatives. The BRICS nations, aware of their burgeoning clout and collective potential, are not just passive observers, but active architects of their destiny. They're leveraging their economic heft to craft a new narrative, one where reliance on the US dollar is not the default modus operandi, but a choice amongst many. In this milieu, the central banks stand as the silent yet potent sentinels of this shift. Their actions, seemingly discreet, are powerful strokes on the global canvas. The trend of net gold buying, a narrative that's gaining momentum, speaks volumes. It's a strategic pivot, reflecting not just market dynamics, but a profound statement of long-term intent and economic prudence. Consider the People's Bank of China, a behemoth in the global gold market, its actions reverberating across continents. Its consecutive months of net gold buying are not mere transactions. They're chapters in a larger story of economic resilience and strategic positioning. The central bank's gold reserves, a treasure trove steadily amassing over the years, are a testament to its long-term vision and its understanding of gold's timeless allure and enduring stability. But the narrative is richer and more complex than a single player's moves. The Central Bank of Turkey, the National Bank of Poland, and other financial institutions across the globe are part of this unfolding saga. Their actions, whether buying gold to bolster reserves or adjusting strategies in response to local market dynamics, are threads in a larger tapestry, one that's being woven with deliberation and strategic foresight. In this evolving landscape, gold is not just a commodity. It's a beacon, a symbol of stability and trust in an era of flux. The increasing gold reserves, the quiet yet consistent accumulation of this precious metal by central banks, speak of a collective anticipation, a preparation for a future where traditional financial anchors are recalibrated in the face of new realities. As we navigate through this narrative, one thing becomes increasingly clear. The world of global finance is on the cusp of a transformation, one that's being shaped not just by market forces, but by strategic vision and a profound understanding of history, stability, and the timeless value of gold. The central banks, with their steady gold accumulation, are not just managing reserves, they're authoring a new chapter in the annals of global finance, one where resilience, diversity, and strategic foresight are the guiding stars. Stay with us as we continue to decode this narrative, delving deeper into the strategies of foresights and the anticipations that are reshaping the world of global finance, one gold bar at a time.
Well, that's beyond anything plausible that can be fixed. It will take a crisis, as I've described in my New Year's podcast, that will make the Depression be a walk in the park. When this is all said and done, when this finally comes apart, all those dire forecasts that people said, oh, I heard you guys for 20 years saying that. Well, it's at hand now. We have the perfect storm. There's a whole bunch of issues: retirement crisis, political paralysis, an immigration scenario that's spilling over to become one of the most formidable problems we ever face, because now day-to-day Americans are being impacted by it. We saw the beginning of it by a school having to be emptied out so immigrants can go while kids had to be forced back home. Once the American life is being impacted by this, it's standing up. First, it started to stand up when they started to come to cities where beforehand those cities said, yeah, you're welcome, until they showed up. But now when it starts to impact day-to-day people, so all these factors that are happening, Elijah, really are setting up a scenario to me where I believe, this is my motto in our planning group, this is what I tell people whether they want to listen or not: don't focus so much on capital appreciation, focus a lot on capital preservation. That's why the products that you're involved with fit that mold. Gold should always be first a preservation investment. There are points, and then there's other ways through mining shares and things like that to look for appreciation. But preservation and protection are more of a viable reason, for me at least, to own gold. And never has that reason been more acute than it is.
Amidst the intricate tapestry of global economic shifts, the dialogue between industry titans offers a rare window into the nuanced understanding of market dynamics, investment strategies, and the foresight that shapes the fortunes of nations and individuals alike. The conversation between James Conner of Bloor Street Capital and Rick Rule of Rule Investment Media stands as a testament to this depth of insight, shedding light on the undercurrents that drive the valuation of assets and the strategic maneuvers of investors. Rick Rule, a seasoned voyager in the tumultuous seas of investment, brings to the fore a perspective honed through years of navigating the vicissitudes of markets, commodities, and currencies. His journey, which saw the ascent of gold from a modest $250 to the dizzying heights of over $2,000, is not just a chronicle of personal triumph, but a narrative of acute understanding, strategic patience, and unwavering belief in the intrinsic value of gold. The discourse delves deep into the fabric of current economic resilience, juxtaposed against the backdrop of historical patterns and future projections. The surprise at the U.S. economy's tenacity, despite the doubling of nominal interest rates, is palpable. Yet, the undercurrent of caution, the anticipation of a recession in 2024, resonates with the lessons learned from the past, mirroring the deceptive robustness that preceded significant downturns in bygone eras. Rick's insights into specific sectors further enrich the narrative. His prognosis of a potential short-term decline in oil prices, set against the specter of inevitable upswings driven by a confluence of anti-energy policies and underinvestment, paints a vivid picture of the cyclical nature of markets. The bullish stance on North American natural gas, underscored by the economics of price arbitrage and infrastructural investments in LNG capabilities, offers a glimmer of strategic optimism in a landscape marked by volatility and transformation. The discourse on uranium further adds layers to this intricate mosaic of market dynamics, the sector's enduring strength despite the easy money phase being over, and the structural shift from spot to term markets reflected deep understanding of the foundational changes shaping the energy markets and the investment landscape at large. The conversation is not just an analysis of commodities and currencies. It's a masterclass in understanding the interplay of economic indicators, government policies, and strategic foresight. Rick's critique of political maneuvers, his insights into the impact of Russian natural resource sales on global prices, and his holistic view of market dynamics offer a panoramic view of the investment landscape, one that's marked by complexity, opportunity, and a relentless pursuit of value. As this dialogue unfolds, it's evident that the world of investment is not just about numbers and charts. It's about stories, insights, and foresights. It's about understanding the subtle nuances that drive markets, the strategic patience that defines success, and the profound respect for the intrinsic value of assets like gold. In this narrative of economic resilience and strategic foresight, every insight shared, every projection made, and every strategy discussed is a piece of the larger puzzle. As we navigate through this landscape, rich with wisdom and insights, let's remember that the journey of investment is not just about reaching a destination. It's about understanding the journey itself, with all its challenges, opportunities, and profound learnings.
About the real economy.
Well, first off, Dunnigan, the very first temporary program or income taxes back in 1907. Those were supposed to be temporary. And we now know that that's not the case. I would say, and I mean, this is a very, very broad perspective, but going back to 2008, the system, the financial system, the credit markets, the real economy, everything has been on life support since 2008. I mean, you went down the list, QE1, QE2, twist, blah, 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 et cetera, et cetera. The patient has been on life support since 2008. And I guess this goes back to what we were just talking about in the last segment, was if it was not for printed money or borrowed money by the Treasury and dispersed, we would have had, I'm not even sure we would have had more than 2 or 3 years of growth since 2008. I mean, it's all been smoke and mirrors. It's all been the system being propped up on life support. And while we're talking about 2008, 2009, none of those, the things that occurred leading up to that caused the great financial crisis, not a single one of those has been addressed. None of those problems have been fixed. Nothing's been changed. The only thing that's happened is it's gotten bigger. The problem has gotten bigger and bigger and bigger, and the life support has gotten bigger and bigger.
In the unfolding saga of our global financial narrative, the spotlight shifts to a more lustrous subject, silver and its intricate dance with gold in the vast arena of commodities. The discourse hosted by Jess Day on commodity culture, featuring insights from Francis Hunt, the founder of the Market Sniper, provides a fascinating glimpse into the dynamics of the silver market, its historical highs, current lows, and the subtle yet significant relationship it shares with gold. Silver, often overshadowed by the radiance of gold, holds its unique allure and intrinsic value. Hunt's analysis of the silver market, seen through the lens of long-term trends and investor sentiment, reveals a landscape marked by patience, strategic foresight, and a profound understanding of the cyclical nature of commodities. The silver market, with its fluctuations and the occasional frenzy like the silver squeeze, isn't just a market of transactions. It's a theater of human behavior, economic strategies, and the relentless pursuit of value. The analogy of a truck, gold, and a trailer, silver, connected by a bungee cord, beautifully illustrates the interconnectedness and potential energy buildup between these two precious metals. It's a vivid depiction of the market dynamics, where the movements of gold often foreshadow the impending surge in silver, a testament to the interconnected nature of commodities and the latent potential that lies within these relationships. Hunt's emphasis on aligning investment strategies with appropriate timeframes resonates deeply, especially in a domain like commodities, where the interplay of supply, demand, and investor sentiment unfolds over a canvas much broader than the daily tickers of the stock market. His narrative is a reminder that the true essence of investment lies not just in the act of buying or selling, but in the profound understanding of macro trends, market cycles, and the patience to see one's strategic convictions come to fruition. The discussion transcends the realm of silver to touch upon the broader landscape of energy commodities, offering insights into the uranium market and its promising outlook based on fundamental factors and market performance. The contrast between the cautious short to medium-term perspective on oil and the bullish stance on uranium highlights the nuanced understanding required to navigate the complex web of commodities trading. As the discourse wins its way through the valleys and peaks of the commodity markets, it becomes evident that this journey is about much more than just the pursuit of profit. It's about understanding the intricate tapestry of market dynamics, the subtle interplay of different sectors, and the profound wisdom that guides long-term investment strategies. It's about recognizing that in the world of commodities, patience isn't just a virtue, it's a strategic imperative. So, as we delve deeper into this narrative, let's carry with us the insights and wisdom shared by Hunt and others. Let's remember that the world of commodities, with all its complexity and allure, demands not just capital, but a depth of understanding, strategic patience, and respect for the long-term forces that shape its destiny. The journey through the silver market and beyond isn't just a venture into a world of assets and trades. It's an exploration of the very principles that underpin successful investment strategies.
That's a good question. So obviously, as you know, my dad said, even the gold bulls now seem to be bearish on gold in the short term, at least. You know, expecting another dip. You see targets like 1800 something. You know, maybe just like test the 200-day line again, which is 1980, something like that. And I mean, that's entirely possible, but instead, what's really happened here is now gold is, I think, into its 8th or 9th week, actually living above 2000. That is a total change for gold, where before, you know, everybody knows each peak that gold has had above 2000 up to 2050 and change, it just immediately gets slammed back down. So you have to take note of that tonal change. And so far, the short-term correction we've had is just retraced ground from early December. So, you know, you are just stuck in this range just above 2000 and 2100 at the high. So mostly I would call that a correction in time instead of in price. And so it's frustrating to the bulls, and it requires patience, of course. And, you know, and as my dad was saying, like, I think this next turn in daily and weekly, and we're watching a lot of shorter term things like our 3-week averages and such, that they're set up very nicely here to say, you know, it could even be this week. We'll have to see. You know, we've had so many hits from all this economic data, so it may end up being next week, but they're getting very close here to a short term upturn, which could trigger those higher numbers. So we're patient here, but we're not, I would say we're not bearish in the sense of expecting a retest of the 1800s. So this is, you know, I think we have to take a win here as far as them living above 2000.
In this intricate weave of global economic shifts, the narrative now turns to a critical juncture: the evolving status of the US dollar. Once the unchallenged bedrock of international finance, the greenback now finds itself in a complex dance of dominance and recalibration. The whispers of de-dollarization, once faint, have grown into a chorus of strategic repositioning by nations seeking to diminish their reliance on the US dollar, not out of whimsy, but as a calculated maneuver in an increasingly multipolar financial world. The dollar's journey is emblematic of the broader shifts in global economic dynamics. Its share in central banks' foreign exchange reserves, though still substantial, has seen a gradual decline. This is not just a numeric fluctuation, but a symbol of the shifting sands of global economic power and influence. The dollar's dominion, while formidable, is being subtly redefined in a world that no longer orbits around a single economic superpower, but is a constellation of influential economies, each carving out their sphere of influence. This narrative is not about the decline of the dollar, but about the evolution of global financial systems. The rise of alternative trade mechanisms, the growing acceptance of other currencies in international trade, and the strategic diversification of reserves by central banks are not signs of the dollar's demise, but indications of a world striving for a more balanced, multipolar financial order. In this context, the US economy finds itself at an inflection point. The potency of the dollar as a global reserve currency has been one of its greatest strengths, offering the US unparalleled leverage in international finance. However, the tides are shifting. The gradual move away from dollar-denominated trade, especially in critical commodities like oil, poses intricate challenges and opportunities for the US. The key lies in adapting and finding ways to leverage the changing dynamics to reinforce the resilience and stability of the US economy. As we explore this unfolding narrative, it's crucial to recognize that the future of the US dollar, and indeed the global financial architecture, is not preordained. It is being shaped by the actions, strategies, and visions of nations, institutions, and individuals. The recalibration of the dollar's role in global finance is a complex, multifaceted phenomenon, one that encapsulates the nuances of economic power, the imperatives of national strategy, and the undercurrents of geopolitical shifts. In this journey through the evolving landscape of global finance, one thing becomes clear: the future is not a destination, but a horizon, ever present, yet always unfolding. The story of the US dollar, like the story of every currency, every nation, and every market, is a testament to the relentless march of change, the perpetual quest for balance, and the indomitable spirit of innovation that defines our global economic narrative.
Well, absolutely. It's obvious there'll be astronomical change in the gold price. It's no longer the suggestion of 1975. We're seeing momentum in that direction. And again, I'm not saying it's an absolute depegging tomorrow or next year. It's already happening indirectly among the BRICS nations. They're finding ways to trade around the US dollar. And I said, even before the announcement when Saudi Arabia with the BRICS, and even during the summer of last year, everyone thought there was going to be a gold-backed BRICS currency. I never thought that was necessary or was going to happen. It wasn't because I'm particularly genius. It just wasn't necessary. You don't have to have a gold-backed BRICS currency to make gold an extremely important part in arbitraging trade among the BRICS. It's like a glorified barter. As I've said before this announcement, or even before the data came out on oil, you can sell oil in London. You can play an arbitrage. You can sell oil in London. You can buy gold, ship that gold to a yuan-based trade hub, and you can convert that gold to yuan and then buy oil outside of the US dollar. And that was already happening among BRICS, certainly was happening between Russia and China, but other nations can do that as well. And you've got Saudi Arabia making deals behind the scenes or preparing to make deals where they can sell oil outside the dollar. Again, this isn't sensational, this is reality. And so even if you have, again, when you look at the global oil production, you look at global gold production, even if you have a small shift in demand for oil outside of the dollar and in some type of arbitrage gold play, the gold price will go up significantly. We're talking this year, we're thinking for a number of reasons, many in our industry are targeting at least 2,500, but that to me is conservative. Again, don't ask me to time it. Gold never moves in a straight line. The direction though, between the BRICS, between the central banks, between the petrodollar, not to mention just the US's massive debt spending. It's an election year. They're going to deficit spend. We went from 33 to 34 trillion quickly. We'll go to 35 and 36 trillion just as quickly. So we're spending more than we earn. The combination of our monetary balance sheet, which is a banana republic, but for the fact the world reserve currency, the combination of that debt reality in the US, the election year spending that's coming, the central bank purchasing of gold over U.S. treasuries, the weaknesses I see in the petrodollar, the momentum I see there, the weaponized U.S. dollar, all of these things point inevitably towards higher gold prices. And again, it's not because gold somehow got shinier or stronger or more immortal. It's just that currencies, including the U.S. dollar, are getting weaker. And this is confirmed by the current events that we're seeing on the headlines and the current movements in the yield curve and the current movements of the Fed and the current movements of geopolitics. But it's also just the fingerprint of history. Throughout history, as I've said so many times, whether you're going to ancient Rome, whether you're going to Yugoslavia in the 90s, whether you're going to the Weimar Republic, which is an exaggeration like Zimbabwe, or whether you're going to 18th century France or the Ming Dynasty, whenever an empire finds itself over its saddle, over its skis in debt, it debases its currency to quote unquote save the system. I see that no different in the US. We are a classic example of a regime or an empire or democracy or a monarchy, whatever example you want to give throughout history, that has way too much debt. 120% debt to GDP, 8% deficit to GDP, negative 65% net international investment. These are just empirical facts. We're broke. We may be the world reserve currency, we may be the strongest economy, we haven't reshored all our manufacturing, but we are broke. And whether Santa Claus, Biden, Trump, or somebody else is the president, or there's a whole new shift, you can't fix that overnight. There is going to have to be some constructive destruction. And the main way they're going to fix it throughout history, it's always the same, I see no exception, is to sacrifice the currency to save the system, to save the US Treasury market in particular. That is essential. The bond market is the thing. We've tried to save it backdoor QE through the TGA program, through different issuance on the short end and the long end, the TBFT program to save the banks. We've been doing backdoor QE. Now Powell's announcing a pause, then a pivot towards lower rates projected in 2024, which I think he'll do. And then eventually we'll see mega QE to support the US Treasury market, which is an unloved asset globally. So they will have to support the Treasury market. To do that, by simple math, they're going to have to resort to synthetic liquidity, i.e. QE direct, to support the yields and to support the bond market at the expense of the currency. That is not gold bug grandstanding, that is history 101. And so that just means more QE, more liquidity, greater debasement of the dollar, higher inflation down the road, inevitable. We haven't beaten inflation, that's another conversation piece, but it's the debasement of the dollar. And so gold's only direction is up and to the right. And again, when you're talking $5,000, $6,000 gold, it's not to be cocky. That just means the cost of bread, the cost of a car, the cost of everything else is going to go up too. including the cost of stocks. It's going to be very bullish for the stock market too, when Powell officially goes from a promised projection of rate cuts to an actual rate cut and then goes to super QE, which I think he'll do. And like Luke Roman, I think it's inevitable. If they don't, the Fed continues to raise rates and just is bluffing, gold wins either way, because if the Fed doesn't support the U.S. Treasury market, everything breaks. Everything breaks but the dollar. The market breaks, it'll be a disaster. That will be depression. That will be a recession. But gold will still rise then. If the Fed pivots to super mega QE, which I do think they will, don't ask me what day, month, or quarter, but they will. They already have indirectly. That's good for gold too. Gold wins either way because the Fed is cornered. They can't win. They're going to sacrifice their currency to save the system, especially in an election year, but especially when you're looking down the barrel of 34 trillion, 35 trillion in public debt. Then you throw in unfunded liabilities, military budgets, fiscal dominance arguments. Again, it's not trying to be sensational. It's really, sadly, pretty obvious right now. I'm glad I'm in gold, but I saw this coming. We've seen this coming, but it's actually happening now or faster.
As the narrative of global economic realignment unfolds, the spotlight now turns to the burgeoning realm of digital assets and cryptocurrencies. These innovative forms of value represent not just technological advancement, but a paradigm shift in the very concept of money and financial sovereignty. In this new chapter of financial evolution, digital currencies are not merely alternatives. They are harbingers of a transformative era, challenging traditional norms and paving the way for a future where financial transactions, wealth storage, and monetary policies are redefined. The rise of cryptocurrencies and blockchain technology heralds a significant shift, offering a glimpse into a future where financial transactions are decentralized, transparent, and beyond the direct control of traditional financial institutions. This digital dimension introduces a novel layer of complexity and opportunity to the already intricate tapestry of global finance. Cryptocurrencies, with their borderless nature and resistance to conventional monetary policies, represent a new frontier in the quest for financial autonomy and innovation. The allure of cryptocurrencies lies not just in their potential as a hedge against traditional financial systems, but in their capacity to redefine the architecture of financial transactions and wealth storage. In an era where the hegemony of traditional currencies is being subtly questioned, digital assets offer a vision of diversification and resilience, challenging the monopoly of traditional fiat currencies and reshaping the contours of financial sovereignty. However, the journey into the digital realm is not without its challenges. The volatility of cryptocurrencies, the regulatory uncertainties, and the nascent nature of the technology underscore the complexities of integrating these assets into the mainstream financial ecosystem. Yet, these challenges also represent opportunities for innovation, for strategic foresight, and for a reimagined approach to financial stability and growth. The interplay between traditional financial systems and the emerging world of cryptocurrencies becomes a fascinating narrative of adaptation, innovation, and transformation. The integration of digital currencies into the global financial landscape is not a question of if, but of how and when. It's a journey that requires not just technological prowess, but a profound understanding of the economic, regulatory, and societal implications. In this unfolding story, cryptocurrencies and digital assets stand not as outliers, but as integral characters in the future of global finance. Their potential to complement or even challenge traditional financial paradigms invites a reevaluation of strategies, policies, and perspectives. As we navigate through this digital revolution, one thing becomes increasingly clear. The future of finance is not just being written. It's being programmed, encrypted, and tokenized in a world where the lines between the physical and the digital, the tangible and the virtual, are becoming ever more blurred. So as we continue to explore this narrative, let's embrace the complexity, the uncertainty, and the immense potential that the digital dimension brings to the global economic landscape. The journey into the world of digital assets is not just an exploration of new forms of value. It's a voyage into the very heart of innovation, sovereignty, and the future of financial empowerment.
The system.
Yeah, funnily enough, I was thinking about this earlier today, and I suspect that as the situation develops, gold will begin to, in terms of its value, it will begin to anticipate increasingly the decline in the purchasing power of paper currencies. In other words, it will be ahead of the price effect, if you like, in the supermarkets and, on the forecourts and all the rest of it. But I think we need to draw a very, very clear distinction. You mentioned the word credit. When it comes to anything which is credit, in other words, something that you don't possess, but expect to possess in the future, contractually or any otherwise, it's that credit which is going to be the real problem. So the really nasty consequences are going to be against credit, and credit includes not only bank deposits, not only bonds, which basically are a promise to pay interest plus the principal at the end of a period, and not even equities, because equities are actually credit. What happens is that you part with, call it money, or credit if you like, some means of a company being able to pay its bills in return for a slug of the equity. What is the equity? The equity, effectively, is a perpetual promise to pay you the share of the profits, your share of the profits in the company. So all these things are credit. Credit is the way in which the whole world actually revolves. And it's not just in financial markets in terms of our personal relationships. Someone comes in, let us say, to mend a window in your house. He does the work and then he submits a bill later. Between doing the work and submitting his bill and you paying it, he's effectively giving you credit. And you expect that to be both parties expect that to be the relationship. Credit is the way the world works. We don't use money. Money is just there to back up credit in terms of value. When we get worried about the value of credit, then we go into real money. That is, I suppose, in a nutshell, the situation I see developing as we get more and more worried about the value of the credit. We've got bank deposits. How healthy is my bank? We've got government bonds. How healthy are the finances of the government? Can they finance their borrowing going forward? If the answer is no, then do I really want to hold on to those bonds? What is the prospect for corporate profits? Corporate profits, again, I've given credit to a company in return for a share of those profits, and it looks like we're heading into recession. Am I going to, what's the value of that credit, as it were, to me? So these are the fundamental questions I think everybody has to ask themselves, and they can best ask it by understanding that they've got credit. It's all these financial bits and pieces are all credit, and where they actually think they own something, in fact, all they've got is a promise to pay somewhere down the line. And that is the thing. What's the value of that promise to pay in these difficult times ahead? It's that more than anything determines the value of a currency. Because what is currency? Currency is faith in the issuer. Currency is credit. Just go and look at the Fed's balance sheet. If you've got dollar bills, it's in there as a liability. If your bank has got reserves at the Fed, it's in there as a liability. What's the value of that liability? Well, it's not tied to international money anymore. It's merely tied to the faith we have in it. And if that faith starts evaporating, it doesn't matter what the quantity in circulation is. If that faith starts evaporating, then it's goodbye credit value. And so all these things, I think, are going to have to be considered by people in 2024, particularly since it's becoming increasingly apparent that the US government is stuck in a debt trap from which the only escape is to cut its spending as rapidly as possible. And is that going to happen in an election year? Well, is it going to happen ever? I would bet the house on.
In the grand theater of global finance, the stage is now set for a deep dive into the geopolitics of trade and the strategic alliances that are reshaping the very fabric of international commerce. The global game of gold is not just a tale of wealth and investment. It's a narrative that intertwines the destinies of nations, the strategies of central banks, and the subtle yet profound shifts in global trade dynamics. In this chapter of our unfolding saga, the spotlight shines on the intricate ballet of international relations and trade agreements. Countries, once passive players in a dollar-dominated world, are now actively scripting their economic futures through strategic partnerships and bilateral trade agreements. This isn't merely a shift in policy, it's a seismic realignment in the foundations of global trade, a move towards a more diversified, balanced, and resilient economic ecosystem. The story is as diverse as it is dynamic. From the energy-rich landscapes of the Middle East to the bustling markets of Southeast Asia, nations are increasingly vocalizing their desire to move away from traditional dollar-centric trade practices. This narrative is not about rejecting the past. It's about embracing a future where economic partnerships are more reflective of the evolving global power dynamics, where trade becomes a dance of mutual respect, strategic interests, and shared prosperity. In this global game, gold emerges not just as a commodity, but as a strategic asset, a fulcrum around which new alliances are formed and economic policies are crafted. The yellow metal, with its timeless allure and intrinsic stability, is increasingly seen not just as a hedge against volatility, but as a cornerstone of a new era of international trade. The strategic accumulation of gold by central banks, the subtle yet significant shifts in gold reserves are not just financial transactions. They are bold statements in a world that's actively seeking alternatives to traditional financial anchors. As the narrative unfolds, the role of gold in reshaping the global financial architecture becomes increasingly apparent. It's not just about the metal's value on the market, it's about its role as a beacon of stability, a symbol of trust, and a bridge between the past and a future where the diversity of reserves mirrors the multipolarity of our world. In this journey through the global game of gold, one thing becomes increasingly clear. The landscape of international trade and finance is being reimagined not just in boardrooms and stock exchanges, but in the very policies and partnerships that define the economic destinies of nations. The shift towards a more balanced, diversified, and resilient economic order is not just a trend, it's a transformation, one that's being written in the vaults of central banks, the corridors of power, and the aspirations of nations striving for economic sovereignty and stability in an ever-changing world. So as we continue to chart this course through the evolving dynamics of global trade, let's remember that this narrative is about much more than numbers and transactions. It's about the aspirations of nations, the foresight of leaders, and the unyielding power of a metal that has captivated humanity for millennia. The global game of gold is not just a story of finance, it's a saga of ambition, strategy, and the relentless pursuit of a more stable, diversified, and resilient economic future.
You go for legal tender status because it makes no sense to have gold and silver as transactable money, and there's a tax on the money that you're using, not to mention the item you're buying. I mean, that's just dumb. So that's a first step. Dunnigan, thank you for bringing that up. And one more thing I'd like to mention is this is a critically important time in history right now where the people can decide what is money. Now, everyone should understand, because sometimes there's misunderstanding. It's not like in the Missouri bill, it's like we're going to gold and silver and we're doing away with the dollar. There's nothing like that. So states that are actually doing anti-CDBC bills and turning them into laws, Florida is one of them. Actually, that's a feel-good bill, unfortunately. And I know that I'm going to get flamed for that. That is a feel-good bill because if you look at Article 1, Section 8 of the United States Constitution, basically the U.S. government gets to determine what's legal tender for the country. But states can actually do above and beyond that. They have to accept legal tender status of anything that the federal government shoves down their throats. But it doesn't mean you have to use it if you have another option in your state. That's where silver and gold legislation comes in. And trust me, gang, trying to get this done on a federal level, you'd have an easier time raising the Titanic with tweezers than you would getting gold and silver legal tender legislation done through the federal government. It won't happen. So it's got to be done through our states. Every state needs this. Every state deserves this. And by the way, we're constitutionally guaranteed.
As we navigate through the evolving tapestry of global economics, the narrative now delves into the complex currents of the global economic outlook. This chapter isn't just about the numbers and predictions that fill the screens of traders and analysts. It's about the ebb and flow of economies, the undercurrents of inflation, deflation, and the forces that shape the purchasing power and stability of currencies and commodities like gold. In this intricate weave, the global economic outlook takes center stage, reflecting a spectrum of possibilities, anticipations, and strategic maneuvers. It's a landscape marked by the push and pull of various factors: geopolitical tensions, monetary policies, trade dynamics, and a collective sentiment of markets and investors. The whispers of potential inflation scenarios are more than just economic forecasts. They are the pulse of a global economy that's intricately connected and ever responsive to the slightest of changes. The impact of these inflationary trends on gold prices is profound. Gold, often seen as the bastion against the erosion of wealth in inflationary times, assumes a pivotal role. Its price, a barometer of market sentiment, reflects not just the current state of affairs, but the collective anticipation of future economic health and stability. But the narrative of global economics is not one-dimensional. The interplay between inflation, deflation, and stagflation paints a picture of a world in delicate balance, where the actions of central banks, the fiscal policies of governments, and the strategic decisions of institutional and individual investors coalesced into the global economic outlook. In this context, the role of gold transcends its traditional confines. It's not just a commodity or an investment, it's a statement of stability, a hedge against the unpredictable tides of currency valuations and economic policies. The price of gold in this grand scheme is a reflection of a multifaceted reality, a mirror that reflects the complexities of global finance, the anxieties of markets, and the timeless allure of a metal that has, through the ages, been a symbol of wealth and stability. As we navigate through the economic projections and market anticipations, it's crucial to remember that the global economic outlook is not just a forecast, it's a living, breathing entity shaped by a myriad of factors visible and invisible. The dance of gold prices in this landscape is not just a market trend. It's a narrative of human ambition, economic resilience, and the perpetual quest for stability in a world that's in constant flux. So as we continue to explore this narrative, let's approach the global economic outlook with a perspective that's as nuanced as the reality it represents. The journey through the economics of today and the projections of tomorrow is not just an intellectual exercise. It's a voyage into the heart of what drives markets, nations, and the collective psyche of investors. In this story, every number tells a tale, every trend has a backstory, and every forecast is a chapter in the ever-unfolding saga of our global economic journey.
You'll note my smile. Despite my age, I'm always planning for the future, and gold is part of my plan. And the idea that I can affect those plans at lower rather than higher prices is what has me smiling. People say to me fairly frequently, Rick, when is the gold price going to move? I began increasing my own personal inventories in 1999. And if you look at the period 2000 to 2023, the price of gold has gone from $250 to over $2,000. So when people ask me when the price is going to move, I would say 2020. It's been moving for 23 years. It's been moving well, below perhaps their expectations, and their expectations matter not to me. Now, gold moves well, historically. Moves well, by well I mean to the upside, when investors are concerned about the maintenance of their purchasing power in conventionally denominated instruments, fiat instruments, in particular important fiat instruments like US dollar instruments. And I believe that investors have a reason to be concerned going forward. In fact, several reasons. The first reason is quantitative easing around the US dollar. James, if you did it, quantitative easing would be called counterfeiting. If you produced wealthions and tried to buy bread with them, they'd put you in prison. But if you were a member of parliament or a member of Congress and did the same thing, you'd be elevated to hero status. Irrespective of the politics, quantitative easing, which is printing more currency without increasing the backing, is in fact counterfeiting. And each existing counterfeited unit does not increase the value of the units that came before it. But a second cause for concern, I think, a second reason why people need to consider owning gold is the credit quality of the debtor, which is to say debt and deficits. I don't know the Canadian equivalent numbers, so my apologies to your large Canadian audience. But in the US, the on-balance sheet liabilities of our government, that is, the debts expressed by Treasury securities, exceeds $33 trillion. But that's not the worst of it. The worst of it is the off-balance sheet liabilities, the net present value, not nominal value, the net present value of entitlements. Medicare, Medicaid, Social Security, federal pensions, military pensions, the Environmental Trust Fund. These numbers, recourse obligations to the taxpayer, exceed, by the estimate of the Congressional Budget Office, $120 trillion. So at the federal level in the United States, not including state and local governments, we owe each other, or rather, the spenders owe the savers, some number over $150 trillion. And we're addressing this debt with a budget that's in deficit $2 trillion a year. By the way, before the impact of higher interest rates on the servicing of the government debt.
In the intricate mosaic of our global financial narrative, the spotlight now shifts to the realm of the investor, a character as pivotal as any in the grand theater of economics. The Investor's Insight chapter is not merely a collection of tips and strategies. It's a deep dive into the psyche of those who navigate the turbulent seas of markets, armed with a blend of knowledge, intuition, and the unyielding will to turn foresight into fortune. In this unfolding saga where the dance of currencies and commodities weaves a complex tapestry of opportunity and risk, the investor stands as the quintessential strategist. Their role transcends the act of buying or selling assets. They are the visionaries who can discern the subtle nuances of market dynamics, anticipate the ripples of economic policies, and craft strategies that resonate with the pulse of the global economy. The wisdom of the investor lies not just in their knowledge of markets, but in their understanding of the broader economic narrative. They see beyond the immediate fluctuations, recognizing the patterns, trends, and potential inflection points that define the long-term landscape of investment. In the context of our story, where gold plays a central role, the astute investor perceives this precious metal not just as a commodity, but as a narrative in itself, a narrative of stability, resilience, and enduring value in an ever-evolving economic milieu. The investor's insight is about harnessing this wisdom, about understanding the interplay between risk and reward, and about navigating the intricate maze of global finance with a strategic mindset. It's about knowing when to hold firm in the face of volatility, when to seize opportunities that align with one's long-term vision, and when to recalibrate strategies in response to the subtle shifts in the economic landscape. As we traverse this narrative, the role of the investor is not just about capitalizing on opportunities or safeguarding wealth. It's about contributing to the broader economic story. Each investment decision, each strategic move is a stroke in the larger painting of our global financial saga. The investors, with their insights, convictions, and actions, are not just passive observers of this story. They are active participants shaping the contours of the narrative with their choices, their foresight, and their unwavering commitment to navigating the complex, yet rewarding realm of investment. So as we continue to chart this course, let's delve deeper into the investor's insight, drawing from the wisdom of those who have navigated these waters before us. Let's remember that in the grand scheme of global finance, the investor's journey is not just about the pursuit of wealth. It's about the quest for understanding, the mastery of strategy, and the art of turning insight into tangible outcomes. In this narrative, every investor is both a student and a storyteller, learning from the past, navigating the present, and shaping the future through the power of strategic investment. As we journey deeper into the narrative of our global economic odyssey, we arrive at a pivotal chapter, one that is rich with anticipation and possibility. This is the chapter of the path to $5,420, a detailed hypothetical scenario that unfurls a sequence of events, a confluence of economic tremors, geopolitical maneuvers, and market dynamics that could propel the price of gold to an unprecedented zenith. In this scenario, envision a world where the undercurrents of economic tension have been silently brewing. Nations, having long sensed the tremors of change, have started to recalibrate their economic strategies, subtly shifting their reserves, diversifying their assets, and reducing their reliance on traditional financial anchors like the US dollar. Amidst this cautious dance of currencies and commodities, gold remains the silent sentinel, its luster undimmed, its allure only intensifying. The path to $5,420 is not a straight line. It's a journey through a labyrinth of possibilities and pressures. Imagine a sudden escalation in geopolitical tensions, perhaps in a resource-rich region or a strategic trade nexus. The ripples of uncertainty spread swiftly across the globe, shaking the confidence of markets, investors, and nations alike. In this climate of uncertainty, gold begins its quiet ascent, its price inching upwards as the symbol of stability and time-honored value. Simultaneously, imagine a series of economic policy decisions. Perhaps a major central bank embarks on an aggressive quantitative easing program, or a consortium of nations announces a groundbreaking trade agreement that sidelines the US dollar. These decisions send shockwaves through the currency markets, eroding the purchasing power of traditional currencies and compelling investors and nations to seek refuge in the enduring embrace of gold. As the price of gold ascends, a critical psychological threshold is breached. Market sentiment, now a potent force, propels the price further. Speculation, investment, and strategic accumulation converge, each step upward reinforcing the belief that gold is not just an asset, but a necessity in this new economic reality. Meanwhile, the world watches as major economic blocks realign, new trade routes emerge, and digital currencies attempt to carve out their space in this redefined landscape. Yet, through it all, gold, with its timeless allure and unyielding stability, continues its ascent, each ounce now a testament to the foresight of those who sought not just profit, but protection and prosperity in its radiant glow. The path to $5,420 is a tale of markets and minds, of strategies and stories. It's a journey that transcends the mere mechanics of supply and demand, touching the very essence of what it means to seek stability and value in a world that's in constant flux. As this hypothetical scenario unfolds, it's a reminder that the future, though unseen, is not unscripted. It's a canvas where the strokes of policy, the shades of market sentiment, and the hues of human foresight blend into the picture of tomorrow. The path to $5,420 in this grand narrative is more than a number. It's a chapter in the unfolding saga of our global economy, a story of resilience, strategy, and the enduring quest for stability in an age of transformation. As the crescendo of our narrative builds, we arrive at the pivotal and concluding chapter, the golden conclusion. This is where all the threads of our complex tapestry come together, where the multitude of factors, trends, and strategic moves converge to deliver the grand finale of our economic saga. The journey to this apex is not just about the ascent of gold or the challenges faced by the US dollar. It's about understanding the culmination of a series of profound shifts in the global economic landscape. In this grand denouement, we distill the essence of the narrative that has been unfolding. The gradual yet unmistakable shift from the US dollar to gold as a primary reserve asset is not a sudden reversal, but the result of a deliberate strategic realignment by nations and investors alike. This transformation, marked by a collective quest for stability and value preservation, sets the stage for a new economic order, one where gold reclaims its historical stature, not just as a commodity, but as the bedrock of financial security. The journey to this point has been anything but linear. It's been a path marked by the ebb and flow of currencies, the recalibration of global trade dynamics, and the subtle yet significant shifts in investment strategies. The resurgence of gold, culminating in its dramatic ascent to $5,420, is a testament to its timeless appeal and the foresight of those who recognize its potential as a sanctuary amid the tumult of economic uncertainties. As we stand at this apex, the narrative offers not just a reflection on the journey thus far, but also a vision of the future. The rise in gold's value is more than a market trend. It's a narrative about the resilience of a metal that has, for centuries, been a symbol of wealth, stability, and trust. This concluding chapter is a celebration of gold's ascent, but it's also a cautionary tale about the volatility of currencies and the ever-evolving landscape of global finance. In this final act, we underscore the importance of foresight, strategic planning, and the recognition that in the world of global economics, change is the only constant. The golden conclusion is a reminder that the quest for stability and value preservation is an ongoing journey, one that requires not just vigilance, but a deep understanding of the forces that shape our economic destiny. As we close this chapter, let's remember that the story of gold, the US dollar, and the global economy is an ongoing saga. The golden conclusion is not an end, but a milestone in a journey that continues to evolve, presenting new challenges, opportunities, and lessons for those who are keen to navigate the complex, dynamic, and ever-fascinating world of global finance.